Good evening. This is Ken Long from Tortoise Capital Management. It's February 1st, 2011, and I want to have a short discussion of probability distributions. In this video essay, I'm going to talk about the standard normal bell curve, another distribution called the log Pearson's type 3, which we often see in financial markets. We'll see how that applies to a short-term silver trade that we did last Friday, and how we use the range stat to estimate realistic gains, and then show what a 10-hour trade in silver looks like. And we'll conclude with some comments about the psychology of trading with respect to probability distributions. So this is a picture of the standard normal curve. It's usually the first one we learn about in statistics. A lot of things in nature are distributed normally, symmetric about the mean. And you'll notice that the tails get thin pretty quickly. As soon as we get out past 3 standard deviations, the tails narrow down to insignificance. And we have this nice, even, smooth curve. Well, that's not the only kind of distribution we see in nature. There's also this one called the log Pearson's type 3. And this probability distribution looks as follows. We have a very tightly constrained left side tail with most of the data clustering very tightly about the average, right approximately here. And then it extends asymmetrically out to the right with an extremely fat tail. It does not tail off as quickly as the standard normal, and in fact it almost looks unbounded. It just keeps going and going. Now, there are different kinds of processes in nature. Some of them produce standard normal distributions, like the height of people in a large population. But this distribution is also found quite often in nature. Hydrologists use this when they're examining the flood data in rivers. This looks very much like riverbank probabilities. The left-hand side is very tightly constrained. It goes to 0. In fact, when the river gets dry, that's where it stops. It doesn't get less than dry. And most of the time, the river stays within its banks and is well behaved. But every so often, we get a lot of rain. We get unusual rainfall upstream, and the river comes out of its banks. And when it does, in a floodplain, there's no telling how far it can go ahead of time. It can just keep going and going and going. Avalanches look like this too. These are power law functions out here to the right. And what happens is when we get past a certain point, we are not able to estimate just how far this thing can keep going. It can just keep going. It doesn't tail off like the standard normal. And so there are two elements of this that we want to consider with respect to our trading. In the first place, this is the kind of a distribution that we want to have to show our multiples. We want to have a very tightly controlled left-hand side of the curve so that we're not taking losses greater than our initial risk. But we want to be open to the possibility of achieving outsized gains in our favor. Now, how we do that is a subject for further discussion. But in general, what we're trying to do is tightly control the left-hand side, the risk, and then be open to the possibilities of larger gains. I'll show you how we do that on an individual trade and how we can do that conceptually when we get to the silver trade. So the log normal is often found in nature. Here's a pillow in the log normal that you can even buy on eBay. All right, so what I want to look at now is a silver trade. Let's see if we can get rid of that. All right, so what we had here is an RFA trade on 2011 January 27th, and the symbol is silver. And the first vertical blue line is the opening of the day, and you can see silver closed at about 26.30. In the next morning, it opened at about 26.15, sold off as far as 26.10, then regained its momentum and then started to take off. Now we're looking at 3-minute candlesticks here. Now, one of the things that have been happening, we know from the gap stat, is that 70% of the time the gaps have been reversing during the day. So if a gap's down 70% of the time, it was going to close lower. And this was one of those cases where we had a gap down and then immediately started to take off. Well, using our WMB technique, the Williams percent R for the W, then MACD histogram, and then a breakout B on candles, we have this kind of setup. We were expecting a sharp move in silver one of these days because it had sold off sharply, and there was political reasons on Friday. We thought the market might be volatile because of chaos in Egypt, and so a flight to quality, flight to precious metals would not have surprised us, so it was on our short list. Silver had also been one of the percent losers among the ETF 200 most liquid ETFs, and so conditions were ripe for a potential explosive move. We know the potential's there, we just don't know exactly when it's going to happen. So it gaps down, sells off. We look now on Williams percent R10 on the 3-minute candles, and it makes an extreme reading. And then we look at the MACD histogram, and what we have is an uptick below the signal line, and that's the M. So W is Williams percent R, M is the MACD histogram signal, an uptick. And then we look for a breakout on candles. And now on the fourth candle, we take an entry, our initial entry at 26.28, because it's moving up with power, and the SPY is selling off harshly, as are all the global indexes. We're able to get a 10-cent initial stop. It continues to take off quickly. We're able to get to no lose very quickly. It consolidates here at about 26.50 and then starts breaking out again. That causes us to enter our second position at 26.57 with an initial stop of 10 cents, and that gets to no lose in a hurry. So now what we have is 2 bullets into this thing. If we exit simply at a scratch on the second position, we're still going to be into this for about a 3 or 4 hour win, but it's taken off with power as it goes up through 26.69, and now it's reasonable for us to say, or to wonder, well, what kind of move could we see today? What kind of move would not surprise us if it followed through? And this is where the range stat comes in. So I'm going to shift now to a new chart, and this comes from page 8 of the daily report called the range stat, and at the top is a collection of indexes that we like to follow, and silver is one of them. And there's 2 time periods, 30-day and a 200-day. And we calculate the distance between the high and the low of each of those days going back 200 days and 30 days. We find the min, the max, the average, and the standard deviation. And then we find this average plus 1 standard deviation. And we define that as the upper limit of the maximum normal reasonable move on a given day. What could we expect to see? And so on the 30-day look-back period in silver, it's 3.12%, and the maximum move intraday has been 4 3/4. If we look back 200 days, the maximum average normal move is 3 1/3%, and the maximum move it had made was about 11%. So we'll just start with the 30-day look back. So if we take that hypothetical low of the day at 26.10 on the initial candle, and then we add I'm sorry, that should read a 3% move, a 3% intraday move plus that 26.10 brings us to 26.90. So 26.90, in my view, is the maximum I could reasonably expect to see if this was just going to be a normal kind of a move, average plus 1 standard deviation. Now, if it goes beyond 26.90, then what that tells me is I have some information that tells me this is going to be an abnormal move. And because stock prices, just like river levels, conforms to a log Pearson's 3, I have a reason to believe that this could be an unbounded move to the upside. Now, what we've already seen in the last 30 days is 4 3/4%, which means a move to 27.30 would not be surprising. And in the last 200 days, we've seen an 11% move. So a move to 29 is not beyond the realm of the possible because we've already seen it. And that's not to say that that's the maximum it could be. So we look at 26.90 then as a reasonable place to harvest a profit if it's starting to hesitate. But if it goes through 26.90 with power, I can expect another 40 cents, and I could expect it to get to 27.30. And if it gets through 27.30, it could go as far as 29 and not be surprising. I'm going to manage my risk all the way up. So let's see what that takes, what that leads us to in silver for the rest of the day. So here was the initial trades, entry 1 and entry 2. After entry 2, we get to no lose pretty quickly. It breaks out from the second consolidation. We take a position at 26.74 with an initial stop at 10 cents. Not really expecting a lot more, but it continues to go. We take the last one at 26.81. And then right at 26.90, it starts hesitating, and we break out, or we get out of that position at 26.85 on all four positions. And what that brings us to is right at 10R. Now, this little pull-off here ended up finding support at about 26.60. We ended up actually taking a second cycle of trades here at 26.80, and in fact it actually went to 27.60 during the day, so it made that extraordinary move. It equaled the best move it had made in the last 30 days and gave us another 5R, but that's a re-entry technique and a topic for another day. So the bottom line, what I want to suggest here in conclusion is that taking a statistical approach or statistical lens to the market, it's important to pick the kinds of distributions that are meaningful. In this case, we're using the log Pearson's 3 to conceptualize our trading, to describe the kinds of R multiple distributions we want in our portfolio from short-term trading, and we want to look for individual trades in which we can very carefully measure the left-hand side of the risk and then be open to the possibility of upside moves. The way we did that in the silver trade at the setup was we had reason to believe that 26.10 was going to be the low of the day. It was moving up with power while the market was failing. Silver was poised for an explosive move anyway. We catch it just as it starts breaking out. We get to no lose quickly, and now we're open to the possibility of extraordinary moves to the upside. And it turns out in this one that we were able to luck into a 10R move. But in each case, we were measuring our risk and managing it all the way up, and then we let the symbol tell us how far to go. The upper limits of reasonable, we bounded with a view towards previous statistical performances using the range stat, and that allowed us to make a sweet exit at vicinity 26.85. The reentry technique is what allowed us to minimize our regret if we see the thing keep going. And again, we keep using a risk-measured approach to doing that. So that's today's short video essay on probability distributions and 10R in silver. This is Ken Long from Tortoise Capital. Thanks for your attention and good trading.